Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Good morning, everyone. It is Tuesday, the 14th of September in cloudy Singapore. Unlike the protagonist in Netflix Money Heist, the market's interest in gold prices has been lackluster so far, so what needs to change? This is the Weekly FX Navigator, and I'm your host, DJ Cheong. In today's monologue, I'll give a brief update on the macro environment, gold's fundamentals, investor flows, and what that means for the precious metal over the next few weeks. So what are gold prices driven by? Firstly, inflation-adjusted USUs. In short, when you purchase a gold bar or necklace, that's not going to give you any income because of its non-yielding properties. Inflation-adjusted bond yields represent the opportunity cost of owning gold. Now that means higher yields should weigh on the precious metal. You can kind of use a long-dated zero-coupon bond as a proxy for gold here. Secondly, the dollar also plays an important role via denomination effects. All things equal, a stronger dollar should weigh on gold's demand, especially in emerging market economies. This is the wealth effect. Lastly, with gold being a traditional safe haven, fears over an inflation surge, debasement fears are supportive for gold prices. This, in short, is the fear effect. However, if risk off flows are a result of yield surging, the effects on gold prices could be pretty mixed. Now, central banks remain a key focus for me. The ECB struck the dovish tone last week despite recalibrating its asset purchases moderately lower. Next week's FOMC meeting will be closely followed, especially the summary of economic projections (DOTS), which may hawkishly surprise the market, which has been priced for a low pace of hikes after liftoff. I believe it is still not wise to write off a taper in September just yet, amid rising financial plumbing concerns and risks of an upward surprise in labour market and inflation data. Now the Fed will likely exert upward pressure on nominal and inflation-adjusted yields, and that suggests gold prices could be susceptible to a decline over the next few weeks. Given the rising importance of retail flows in gold, lackluster ETF interest is a headwind for gold prices, with investors not responding to price dips as eagerly this year. The physical market, on the other hand, which in this case mean the markets for gold jewelry, coins, bars, etc., will likely set the floor for gold prices, possibly at around 1700. Technicals are arguably mixed for gold. Key moving averages such as the 50, 100 and 200-day moving averages are all flat, with the precious metal hovering just below them. We believe gold prices will struggle for upward momentum and expect key resistance to hold at around 1835. With that, this brings us to the end of my monologue. If any of my thoughts and bullets have piqued your interest, I would suggest heading to se.com and look for our publications under the tab titled Latest Market Insights. If you're a valued client of Standard Chartered, grab hold of your relationship manager to find out more. If you've liked what you've heard, remember to like, share and subscribe. If you want us to cover a specific topic in subsequent podcasts, drop us a comment on the channel and we'll get to it. We'll see you on the next episode. Bye-bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.